We do a little bit of a deep dive onto the Trump tax cuts, specifically the 2017 Tax Cuts and Jobs Act. This is what we're going to go into specifically, okay? So we read a paper from the Dallas Federal Reserve, which gave a lot of interesting insights with a lot of great sources referenced throughout that we're going to be that we're going to go into. But first, let's give a little breakdown of what the Trump tax cuts did. So first, it decreased tax rates from basically almost every bracket. The first bracket from $0 to $10,000 stayed at 10%.
Mm-hmm.
9,000 to 40,000, 15 to 12. 40,000 to 90,000, 25 to 22. 90,000 to 200,000, 28 to 24, and so on and so forth. And the marginal rate went down from 40 to 37. So generally, taxes went down across the board, but most of the tax of this bracket reorganization benefits the most wealthy in a lot of ways here.
Do you think so? So that was something I was curious about, because that's how it kept being described. But I'm seeing this decrease from 15% to 12% on 10,000 to 40,000 seems very significant for that bracket, right? I'm seeing the same from 40,000 to 90,000. These are decreases that seem to be working for the middle class.
These marginal changes doesn't take into account the differences in tax deductions that people were allowed to take. But so this limited the number. So another thing of the Tax Cut and Jobs Act was it eliminated a lot of possible deductions for state and local taxes that people were able to take advantage of previously.
Okay, interesting. Because it increased the standard deduction.
Yes, it did also increase the standard deduction.
Yeah. So I don't know, like, I'm curious whether those specific itemized deductions, were they more beneficial to the middle class and working class?
Well,
because the standard deduction, I think, was around doubled from something like 6,500 to over 12,000.
I'm gonna cite this. This is a research paper with by David Weiner. He's the main author. The effect of the Tax Cut and Jobs Act, individual income tax provisions across income groups and across the states. I'm going to read through a little bit of the abstract here. The Tax Cuts and Jobs Act will reduce individual income taxes on average for all income groups in all states. Unlike prior tax policy center reports, this analysis focuses on the distribution of the individual income tax changes and does not include changes in the corporate income tax, excise taxes, or estate and gift taxes. It will also extend the analysis of and then we go here. We estimate that in 2018, the Tax Cut and Jobs Act will cut individual income taxes for 65% of households overall, but will raise taxes for about 6% of households. Only 27% of households in the lowest income quintile will receive a tax cut, with most having no material changes in their taxes. The individual income tax cuts as a percentage of after-tax income will be largest for high-income households, particularly those in the 95th to 99th percentile of the income distribution, and we estimate that between 60 and 76% of taxpayers in every state will receive a tax cut. So we're saying that the lowest income people are not receiving a tax cut. The middle class is receiving a modest tax cut, and the upper class is receiving a large tax cut.
I'm curious. I don't understand, to be honest. It's okay. I'm worried that I'm not going to be informed enough for this discussion.
No, it's all right.
But I'll try. Okay, so maybe, so it does say 27% of the lowest quintile did have their taxes decreased.
Yeah.
So that's something.
It's something.
But the biggest deductions are going to the highest earners, and I assume that's because of this 3% percentage point drop in the highest bracket.
Yeah, and it's not just that. We're talking about also he changes the estate taxes as well. So incomes that exceed 11.2% are now subject to
11.2 million.
Oh yeah, I'm sorry, 11.2 million are subject to a 40% estate tax at time of death. It used to be 5.6. So now we were talking about in Stiglitz about how the transmission of wealth, this is a huge now hit to that, where the transmission of wealth is becoming a lot easier for the richest.
Yes. Yeah, that's fair. So next thing you have here, I see corporate tax rate.
Yeah, corporate tax rate.
Yeah, so
and that's a huge one.
This I dug into a little bit. I think you have 39 here. I thought it was 35.
I think something around there. I don't know.
It went from 35% down to 21%.
Yeah.
This is on corporate profits. Trump wanted it to be 15%, ended up getting it at 21%. You say that many could go down to zero because of
Netflix
tax credits.
paid zero, Amazon paid zero.
Yeah.
Some of the biggest corporations in America were able to pay no corporate income taxes because of the deductions they were able to take through the Tax Cut and Jobs Act.
Yeah, that makes sense. And so this part I looked into a little bit because I was hearing that the corporate tax change was kind of the meatiest part of the tax code change. And the idea was that because we are taxing corporations too much, we're driving them away from America. And we need to reinvigorate investment in America by reducing the corporate income tax rate.
Right.
I read a paper that said that investment did increase, specifically private investment with retained earnings significantly increased. And it was like additional investment from, say, exogenous entities or companies that were not internal, so not retained earnings.
Right. That
wasn't really moved by the tax cuts. But increasing investment, like I wanna try to be as impartial as possible here.
Yeah, of course.
Like that seems good. That seems helpful.
Yeah. And look, I think 39% corporate income tax rate was too high. I think that was bad policy. I think that the with Biden's new Inflation Reduction Act having a 15% minimum tax for any corporation exceeding $1 billion of profits reported, that's great. I think that's great. But that's going to tax more out of Amazon and tax more out of Netflix that are maybe investing in tangibles per se.
Sure.
I know that the tax cut inspired or caused a lot of stock buybacks and stuff, which is not what we want to see. But there was definitely more investment. And as we'll get into, there was GDP growth because of the Tax Cut and Jobs Act.
Yes.
It was not all bad. It did do something. And so this paper written by the Dallas Fed, it starts off by showing that previous multipliers to tax cuts are estimated to be around 1 to 3.5. Now, what's a multiplier? A multiplier is change in GDP growth. So he was like, previous literature suggests that tax cuts will have a 1% or a 3.5 multiplier to GDP. Where in that realm did the Tax Cut and Job Act fall? Was it in 1? Was it closer to 3.5? Where did it fall? Well, weak economic activity, in eras of weak economic activity, in times of recession, that's when a tax cut's super effective. That's when a tax cut is going to be able to get you to that 3.5 number, probably on the upper end of that multiplier. But he suggests that it's on the lower end. And the main finding is that there was a 1.1 the main finding is that tax shocks equaling 1% of GDP. So with a 1% reduction of GDP in tax collected, that led to a 1.3 percentage point faster job growth and a 1.5 percentage point higher GDP growth. That's a fairly positive development. With 1.5% GDP growth, being added on top of what was expected, that's great.
Yeah.
When you average that out, that's $105,000 per job and a multiplier of 1.5. That $105,000 per job number, I think, is important.
Yeah.
Did you have any analysis suggested? Like, did you have any metric to think, like, is that number good or bad?
I mean, so $105,000 per job. I'm thinking if we're equally distributing here, it means it means jobs should be making $105,000
Oh, no,
more
no,
per.
no. That's not what that means, though.
I know it's not what it
Oh,
ends up happening as.
right.
Because it ends up going to the top.
Right.
Which is the issue.
Yes.
But that's kind of my initial thought. And then you need further analysis to determine how much did trickle down.
Right.
And the answer is almost certainly none, very little.
So something I've done in my free time, because I'm a nerd, was like a year ago, I've been accumulating this big document, and I've been studying the effects of 2008 stimulus package. And
that's awesome.
I know. So in the CBO report, the Congressional Budget Office report of the American Recovery and Reinvestment Act, the cost per job was $45,000. In 2017 dollars, that's $51,000. So $105,000 per job in the Tax Cut Job Act, $51,000 in the stimulus package. Government spending versus tax cut cost half as much per job. Now, the environmental difference is that the stimulus package was done during recession, so any multiplier is going to be higher than a tax cut done in a time of economic boom. But then this challenges the question, was this the right time to do a tax cut?
Sure. Was
this the right time to do a tax cut? Because what is the opportunity cost of all the money that the government now doesn't have? Yes, we had 1.5% GDP growth, that can be accounted for this, which is good. And we had 1.3 million more jobs, which is great. But was that the best way to use that money? Would have going into more research increased productivity more? And these are the questions we have to ask. And I think that, his methodology in the paper is actually really great. If you're interested in math and econometrics, I recommend you to go read the Dallas analysis of the Federal Reserve. I'm not going to go into all the metrics and the analysis methodology here, because that'd be more boring than it already is. But it's really cool stuff. It's really cool stuff, the way he was able to figure it all out.
Yeah, it's interesting because I did read a paper from Brookings. One thing that he said, I forget the main author of the paper that we're talking about.
I forgot his name too.
But
I'm terrible for that.
But there was another paper in Brookings that kind of teased this out in a different way. And I'm not good enough at following the math, unfortunately, to determine which, to make a statement on which I believe. But the Brookings article said that the GDP increases can largely be accounted for by changes in oil prices, which interestingly enough was specifically teased out as a factor in this paper as something that was not the reason for these GDP increases, and instead the Tax Cuts and Jobs Act should have been given credit for the GDP increases.
You're saying that the Brookings study said that the tax cuts didn't contribute a lot to the GDP growth. A lot of it was due to oil.
Yes.
So this Dallas report actually he includes oil in his model for GDP growth to pull it. So he controls for oil prices.
Yeah.
He controls for oil production. And he even controls for state by states. So states that are more reliant on natural gas, he makes a note of that.
Yes.
Or states more reliant on oil, he makes a note of that in his model.
Yeah.
So he takes into account that Brookings and challenges Brookings' findings.
Exactly.
And says, so you're telling me that Brookings said tax cut not that effective, and then Dallas Fed says, you know what? Kind of is, even despite oil.
Yes.
Interesting.
Yeah, exactly. And the Brookings paper specifically says, oil sees the biggest returns, the biggest increases, and the returns on everything else are kind of negligible. The growth in all these other sectors is negligible.
Interesting.
It is very interesting. I totally had something else. The other main point that I had looked into is the idea with these corporate tax cuts was going to be it's supposed to be a supply side effect. So it's because there's lower corporate tax rates, there's more investment, which means there's more production and supply that comes into the country.
Yes.
And studies that I read, briefly skimmed, but at least figured out the abstract, said that it probably didn't change anything on the supply side.
Mm-hmm.
And instead, the economic gains likely came from the income tax reductions,
Yes.
which raised demand.
Exactly. And that. I'm so glad you said that, because that leads to the last paper I looked at for this, by Owen Zidar, and this is great. And at the end of his abstract, he says, I find that the positive relationship between tax cuts and employment growth is largely driven by tax cuts for lower income groups, that the effect of tax cuts for the top 10% on employment growth is relatively small. And I think that's really great. I think because that's demand. That's demand side economics, because the people at the lower end are more likely to spend their income than the higher ones, than the people at the higher income brackets. So tax cuts for lower and middle income people are actually a really effective way to drive economic growth in times of recession. Now, am I going to say that I'm always going to be in favor of middle class and lower class tax cuts at every turn? Maybe for lower class, but not really for middle. I think tax revenue is a good thing to have, because I think the government can spend money in good ways, really beneficial ways. But in times of recession, middle class and lower class tax cuts should be a prime component of any stimulus package going forward. Absolutely.
Yeah.
And I think what we see out of the Tax Cuts and Jobs Act is the Dallas Federal Reserve says 1.3% multiplier to GDP, not too big for a tax cut. Brookings says really not that much effect. We see that that production didn't really increase too much from the corporate tax cut. And what this goes to show you is that this was more of an ideological thing than a true utilitarian thing. They didn't really, they didn't. This wasn't maybe like the goal of this thing wasn't solely desired to spur production. It was inspired for capital gain.
Sure.
You know what I mean?
Sure.
I mean, I don't know. What do you think about that?
I think it was both. I think it really, this is a perfect example of like when I learn more about something, it becomes much, much more nuanced to me.
Of course.
Because like you read Stiglitz and it's just like, this bad.
Yeah.
This act is a problem.
Yeah.
And I think as I learned more about this and I learned, okay, it does reduce income tax rates for the lower brackets. It like, okay, there is like, I can see an argument for lowering the corporate tax rate to incentivize investment. And the problem is that that trickle down doesn't work. But if we can maybe institute some other policies that force a greater distribution of corporate income within a company, like I do still want companies to be investing on U.S. soil.
Totally.
It did double the child tax credit. Trump did want to increase the earned income tax credit. So it's, even if there are problems with it, like I don't like that the tax on the top bracket decreased 3 percentage points.
Yeah, that's
a problem. I think that should go up. But there are good things here, and it just like it needs tweaks, adjustments. I think the Biden IRA minimum corporate tax rate of 15% is a perfect example of one that that really fixes a major loophole left in the Trump tax cuts.
Totally.
But good and bad.
I think, they're going to be voting on it at some point soon, in many years, they're going to be voting on whether or not to extend the Trump cuts for the middle and low income people, whether to extend it further into the future. And what the Trump tax cuts made the cuts for low income sunset and the high income permanent. So we need to now pass again to lower the tax, to keep the tax rates on the lower and middle income lower.